Future contracts. Today we are going to discuss about what is future contractors. So, in our previous video, we saw that two parties can agree today on a price for buying or selling an asset in the future. But there was one major point. What if one of the party refused to honor the agreement? This is called counterparty. So how can this risk can be reduced? The answer is future contract. Let's begin with a simple example. Imagine you are a coffee shop owner. Every month you buy coffee bean from suppliers. Today coffee bean costs 500 per kilogram. How much? 500 per kilogram. But weather forecasts predict a poor harvest and experts believe prices may increase next month. You wanted to protect your business from rising price. Instead of making a private agreement with a supplier, you buy a future contract through a recognized stock exchange, right? The contract allow you to buy coffee bean next month at 500 per kilogram, regardless of the market price at any time. This is called future contract. So what exactly is the future contract? The future contract is a standardized agreement to buy or sell an underlying asset at a predetermined price on a specific future date. Unlike a forward contract, a future contract is traded on a recognized stock exchange because the exchange supervises the transactions. Future contracts are considered more secure. Now let's see what happened on the settlement day. Suppose 1 month later, the price of the coffee bean increased to 550 per kilogram. Since your future contract fixed the price at 500, you gain from the price increase. But if the price fall to 470, the contract loses the value of yours, while the other party benefited. Just like a forward contract, both parties are expected to fulfill the agreement. So, what makes future contract different? The biggest difference is standardization, sir. In future contract, you cannot decide the contract size, the expiry date, or the trading rules. These are already fixed by the stock exchange. Everyone trades under the same standardized condition. Another important feature is the clearing corporation. Think of it as a trusted middleman. Instead of buying and selling depending directly on each other, the clearing corporation standards between them. It guarantees that both parties fulfill their obligation. This greatly reduces counterparty risk. You may also hear the term margin. When trading futures, you don't usually pay the full value of contract immediately. Instead, you deposit a small amount of money called the initial margin. This act like a security deposit and helps ensure that both parties and buyers and sellers meet their commitments. Another interesting features of future contract is daily settlement, also known as market to market. Every trading day, profit and losses are calculated based on the market price. If the market moves in favor, money is credited to your account. If the market move against you, money is deducted. This daily adjustment reduces the changes of large unpaid losses building up over time. Now let's look at the advantages of future contracts. They are highly transparent because prices are visible to everyone. So you need not to negotiate at all. So second one is they are standardized, making trading simple and effective. They are high liquidity, meaning contracts can be bought and sold easily. And most importantly, they carry much lower counterparty risk because the exchange guarantee the transaction. However, future contracts also have some limitations. Since the contracts are standardized, they cannot be customized to meet individual business model because the need might be different for each and everyone. So as per their convenience, we cannot able to do that. Also, daily settlement means trader must regularly maintain sufficient balance in their trading account. Okay. Now let's quickly compare the future contracts and forward contracts. A forward contract is a private agreement traded in the OTC market. It is flexible and customizable, but carries higher counterparty risk. The future contract, on the other hand, is traded on the stock exchange. It is standardized, highly transparent, more liquid, and much safer because of the clearing corporation. So this is what futures contract.